quite a tumultuous time of it when it comes to sovereign bonds. I'm just looking at the Treasury market as well. Yesterday we saw the long end 30 years below 2%. We've got at the moment 1.48% the handle at the moment on the 10-year. What are we actually pricing in here? And are they really taking on board what Jay Powell's been saying?
Indeed. Thank you. A pleasure to be here. So I think bond markets have been whipsawed over the last day or so, and there is some sort of in the aftermath of that fitting of narratives to the price action. I think the Fed surprised with its quite hawkish tone, and we went from wondering if we're going to get 2 dots or 3 dots or looking at dot pictures to wondering if we might get a policy error. And that has taken place over a very short span of time, such that the volatility in US Treasuries has been something that bond market investors have struggled to really keep pace with. What I think we're pricing in today is, I guess, a return to the orthodoxy that the Fed will stay data dependent after the excitement of the last 24 hours where we anticipated, maybe premature hiking or withdrawal of easy monetary conditions, to a view that perhaps tonight, with Powell speaking, we might get a more moderation of that position, or at least that's what the market seemed to be expecting.
Is he got one hand tied behind his back, Alan? He's so wary of not creating another taper tantrum as Ben Bernanke did in 2013 that he's really at pains to say that it's going to be very, very data dependent, it's going to be a while from now, etc., etc. Plus, we've got the average inflation also measure that they'll be looking at rather than day-to-day inflation or month-to-month inflation. So, in a way, do you think that ultimately they may fall behind the curve?
Look, it's an unenviable position to be in. We've never been, in this position before, which is synchronized global reopening from a pandemic. They certainly have a very difficult job to both communicate and articulate very clearly what they intend to do, because they too, like the rest of us, are hostage to the data. It's all very tempting to try with very few data points to extrapolate, to try and connect dots before you can see the full picture. But that's what the market has been trying to do. And I guess what they keep reiterating over and over again is that they will, like the rest of us, be subject to the data, be cognizant of the data as it emerges. So, it's very tempting to try and, look out a year or two ahead. That's, I guess what market discipline and market practice preaches. But we may be better off trying to take a step back and allow, the world to catch up to itself and to us. And so they are operating under very difficult conditions, because if you like, they have a number of major tools which they can't really pull, which is, the actual hikes themselves and the taper. So most of the activity has been talking, which they've raised to an art form at this point.
The thing is, they have started talking. Alan, the thing is, some people in the market keep going back to the taper tantrum back in 2013. Should they be doing that when the situation today is very much different from then?
Look, I'm not sure that they have a lot of choice. We are in a period now where market data points are still having to contend with these base effects, right? So we're at the very early stages of this recovery. We are facing very favorable comparables. So if you look at the data and the surprises that we've seen in inflation and less so in employment, one could be forgiven for thinking that they could just be a lot more orthodox and tie themselves to that. But they have to allow room for error. And hence, there's more shading around the language. And I think we just have to be considerate of that.
When we take a look at the Chinese bond market, it's been attractive because of the high yield. And also now people are talking about it being a safe haven play. What opportunities do you see in China's bond market?
So at the moment, I think the Chinese government bond market, so that's the domestic, CNY denominated market, is very attractive. Second largest bond market in the world, playing a larger role in indices and offering at the headline bond level, double the yield at half the duration of US Treasury bonds. So as a macro construct, it is a very attractive instrument in an economy that is in a different place to the rest of the world right now.
It is a huge bond market, and investors are increasingly getting in, foreign investors there is, but they account for still a small percentage. I mean, when do you see that reversing, and what will that mean for China's bond market going forward?
We're very excited about more foreign participation in the onshore bond markets, both because of the increasing prominence of China within indices, but also because of China's increasing role in global trade. So as more and more investors become comfortable with direct allocations to China within the fixed income or macro portion of their portfolios, we expect this to increase. Current penetration is around 4 to 5%. Versus, let's say, 25% foreign investor holdings of US Treasuries. So there's a lot of scope to grow. And given the size, this is going to be a durable trend over the medium to long term, we think.
Alan, tell me something. I mean, I'm going to just broaden this out to emerging markets and looking at fixed income there. We, of course, will be seeing interest rate hikes in the future out of the US, some ways away, right? The thing is that there could be this sort of move out of emerging markets once we see that the spread become less attractive. Give us your views on that. And really having, I suppose, a big cushion of foreign exchange reserves may not actually help you that much in this. What's your view?
So we do think emerging markets today are in a different position to the last time we had, the taper tantrum and also prior crises that we've had in EMs overall. The sovereigns and the corporates are, broadly speaking, in better shape today. All fixed income, in fact, all risk assets are vulnerable to a rise in rates. But we think there are circumstances such as if rates are rising because the world is in a good place, growth is there, and we're experiencing a reflationary episode. I think that could be very positive for emerging market risk assets overall. So we're not unduly concerned that the key risk that we're worried about is obviously a policy error. So where we get either too much tightening, not enough growth, that type of scenario is what we're mostly worried about.
Well, my next question is, how does the dollar play into all this, and what is your view on the dollar?
So I think dollar strength has been one of these things that has been unanticipated in this period of very, very low rates. So as EM investors, particularly in the dollar space, there are ways to get exposure to emerging markets, particularly in corporates where we benefit, I guess, because we don't take outright FX risk. A lot of the corporate debt obligations that are issued by the highest quality companies in the emerging markets are issued in dollars. And so once you've done the bottom-up work to make sure you're comfortable with these companies and their ability to continue to generate cash flows and maintain sound balance sheets, then the dollar becomes less of a risk in this part of the market.